Here is a clear step-by-step procedure of how to calculate your capital gains tax that applies to your bamboo investment. There is no specific place on your app where you can do that. So what you have to do is that you should know what triggers the tax. Capital gain tax only applies when you sell an asset for a profit. Unrealized gains, shares sitting in your portfolio that have gone up in value are not taxed until you have actually closed the position and sell. Then this is how you calculate. Subtract your initial purchase cost and transaction fees from your total selling price. Tax is charged only on the net profit, not the total amount you withdraw. Then you have to identify the applicable tax rules. If you trade local Nigerian equities, capital gains on listed shares are generally exempted. For foreign equities like the US stocks bought through bamboo, realized profits fall under standard capital gains tax rules. They are charged at a flat 10% rate on realized gains. So other thing to do is separate your dividends from capital gains. Dividends paid or held stocks are distinct from capital gains. So US dividends are subject to withholding tax at source before credited to your wallet, whereas capital gains tax applies when you sell the stock itself. So you have to download your financial statement. You go to your profile in the bamboo and export your annual trade report. This document gives you the exact purchase prices, selling prices, and the realized net gains needed for your tax reporting. Then you have to file your returns. So include your next realized gains in your annual personal tax refiling with your relevant state tax authority. Thanks for watching and see you in the next video.